Hi everyone, and welcome back to another episode of Talking Trusts. Today I'm joined by Dean Orrico. Dean is the manager of Middlefield Canadian Income. So Dean, thanks very much for joining me.
Good to be here.
Now, Middlefield was actually mentioned just this weekend in an article in the Times, and I thought that was quite a good way to kick things off. So the sort of topic of that article was that Warren Buffett was looking at the Canadian market and potentially finding some attractive things there. So, perhaps building on that, what is there in Canada today that investors should be interested in? Why would an investor like Warren Buffett be interested in the Canadian market?
Well, it's great to see that Warren has come around to what we've known for quite some time. And the reality is Canada, being a very different market from the US, has a number of infrastructure businesses, both inside and outside the energy sector, that I think are extremely attractive. They are significant free cash flow producing businesses. They pay high and growing dividends. And if they're involved in or tangential to the oil and gas business, I think the perception of oil and gas has changed quite a bit over the past 2 years or so. And I think it started with Russia's invasion of Ukraine, when Europe basically realized they could no longer rely on Russian natural gas as a safe and stable source of baseload power, fuel for baseload power. And I think given Canada's abundance of natural gas, we're a top 5 oil and gas producer in the world. We're a net exporter of oil and gas. And as a result of that abundance, we've got a number of really attractive businesses that I think Warren Buffett, would likely have an interest in because they're trading quite cheaply and there's a really good long runway for these companies.
Yeah, and I'm sure we'll touch on those things shortly. Now, you and I spoke, I think it was about a bit less than 12 months ago. I think it was August of last year. And one of the points you made there were you guys thought that rates were likely to come down actually more quickly than in the US. And part of the reason for that was that Canada was actually very quick to hike rates and sort of get inflation under control. Do you still think that's the case? I mean, where do we stand today?
Sure. So you're right. About a year ago, we thought rates would come down sooner in Canada versus the US. We still think that, but unfortunately, we were wrong on our timing. So we would have thought by now that we would have seen some cuts. And recall that the market, based on the dot plot from the FOMC, was expecting as many as 6 or 8 cuts this year, and we're lucky if we get 2 in the US. But Canada's inflation number has come down faster, so we're at 2.8, 2.9%. We get another read tomorrow, Canadian CPI. And the markets are telling us today that we'll see a quarter basis point cut either in June or July of this year, with a few more towards the end of 24 and then going into 25. So it's our view that just based on the data and where inflation is going, that rates will be coming down. Having said that, I think the days of 0% interest rates and little to no inflation are in the rearview mirror. So that decade of 2010 to 2020, when money was free, we don't think that's coming back anytime soon. So I think you're in a higher rate environment relative to that period, but certainly lower than where we are today.
Yeah, and I think it's probably worth highlighting though that, as you mentioned, Canada has this natural gas and oil industry that's sort of helping keep prices lower than perhaps they would be elsewhere. But that sector is also quite a big part of the MCT portfolio today. Can you sort of talk through the thinking there? I mean, what are the sort of facets of that sector that you think are attractive, and perhaps how they feed into the trust investment objectives as well?
Sure. So when I think about the Canadian market, and I often get asked, well, it's actually similar to the UK market. I says, yes, it is. It's actually very similar in size and market capitalization. But in composition, there is one major difference in that the energy sector and mining and materials in aggregate represents about 35% of our market. And that's far greater than what you're seeing here in the UK. So we've got a very well-established energy infrastructure area. So specifically, these would be pipeline businesses, natural gas, gathering and processing businesses. These would be power generation businesses. all of whom trade publicly and are characterized as energy pipelines, energy infrastructure, or as utilities. And they would represent significant portions of MCT's portfolio. And what we love about those businesses is that they are truly stable and growing dividend payers. They typically sell their capacity on a take-or-pay basis. So if I have a pipeline, if I'm Enbridge, for example, which would be one of our largest weightings, $100 billion market cap plus business in Canada, I've got pipelines, I sell the capacity to producers, and you either take that capacity or not, you still have to pay me. So they're very contractual revenue streams. And they've also got other elements of their business that they're growing marginally over time. So you're getting anywhere from a 6 to 7% annual yield that grows anywhere between 3 and 5, 3 and 6% per annum. We love those kind of businesses. We'll own them all day long. And there'd be those kind of businesses that I think Warren Buffett probably be looking at pretty carefully because they're trading cheaply and the fundamentals are so attractive right now.
Yeah. And, actually, when we spoke last year as well, another area that is very overweight as well is real estate. And I think, again, that's another sector where the fundamentals, at least when we spoke last time, and I would say the positive story has continued, looks pretty good, but the market might not be recognizing that. Can you talk through those holdings as well? Because in some ways, that's the most striking. I think if you were to look at the portfolio fact sheet, that would probably be the most striking feature. So can you talk through that and perhaps also the sort of population growth that might be feeding into that as well?
Sure. So let's start on the latter part first. So Canada's a country of about 40 million people. Last year, we took in about 500,000 permanent residents, and that's been the case roughly between 400,000 and 500,000 for the last few years. That'll probably be the case over the next few years as well. We have a shortage of labor. They've got a points-based immigration system in Canada that basically gives you more points for your age and your education. So about 60% came in under the economic class. These are basically people between the ages of 29 and 54 who can immediately contribute to the workforce. So by and large, that's worked pretty well. We've also had a large number of non-permanent residents come in, and that's foreign temporary workers as well as international students. Those numbers and the quotas for those are coming down, because we want to make sure that whatever population does come in or immigration does come in, the economy can handle it, the infrastructure can handle it. So right now, that's clearly a big number that governments are looking to lessen. But the impact from our perspective as investors is very positive as far as real estate goes. So the fundamentals in the Canadian real estate sector, both multifamily apartment rentals as well as commercial, aside from office, are as good as I've seen it in 10 years. And on average, the sector trades at a 20% discount to NAV, so not dissimilar to what you're seeing here in the UK. And whether I'm talking multifamily, the apartment rentals, or open air, grocery anchored retail, seniors housing, also very, very solid footing, as well as areas that we like that are even in the US market called data centers. We think the outlook for all of those continues to be very attractive, but the market doesn't seem to care right now because most of the investors who might own a REIT are sitting in relatively risk-free cash-like instruments, giving them 5%. And I often get asked, well, when rates come down, if you're right and rates do come down, does that money not go to tech? I think that money's not going to go to tech. The money that was going to go to tech is probably already going to tech. I think people who are sitting in 5% relatively risk-free paper who realize that over the next 3 or 4 months, maybe they're only going to get 3%, they're going to start looking at things like REITs and utilities that are giving them very comparable yields that'll grow over time based on the fundamentals and are trading at a discount to NAV. Those are the reasons, David, that we're overweight that sector. We think it's like a coiled spring here, that over the next 6 or 12 months, we're expecting total returns from our REIT portfolio of 5 or 6% yield plus as much as another 10% capital appreciation, 10 to 15% capital appreciation. That's the kind of total return we're expecting.
Yeah, it's really interesting. I think actually if rates did come down, as you said, they probably wouldn't go to those kind of 0% levels that they were at previously. So again, less incentive to put money elsewhere. Well, perhaps to finish off, the other sector that is big part of the portfolio is financials. And again, I think over the last couple of years, sort of comparable to real estate in the sense that I think it's a sector people have been a bit wary of, perhaps unsure of. However, having said that, I think, again, Canada is very different from the US, but I think in the mind of a lot of investors, they sort of put the two together, which might not be the correct thing to do. So can you sort of talk through that opportunity? What's the outlook there?
Yeah, our financials are by far the largest part of our market. They're over 30% of our benchmark. We're sitting at 23, 24% in the MCT portfolio, so still a healthy weighting. They're trading today, our banks are at about 9.5 times versus closer to about 10.5 times earnings. So they're at a discounted valuation. And as interest rates have gone up and stayed higher for an extended period, you're seeing the squeeze on earnings because they're paying more for those deposits. And unlike in years past where investors weren't that aware of the interest they were earning on the cash in their savings account, more and more investors are aware of that and demanding higher rates from the banks, and that's squeezing the margin for the banks. The other two legs of the stool for the Canadian banks would be capital markets, and we all know that's been pretty quiet. Capital markets activity really has been non-existent. And then wealth management. And similarly, the wealth management division of a Royal Bank of Canada, for example, those clients are sitting in cash-like instruments earning 5%. They're not fee-bearing types of instruments that the bank is going to benefit from. So we think over time, as rates gradually come down, that money comes back into the market, and we think those banks will do well. So we think they're also well positioned, and they're extremely stable. So when you think about our Canadian banking sector, we have not cut a dividend in a Canadian bank since World War II. So think about the global financial crisis where the US banks virtually all got wiped out. And then in the pandemic, UK European banks all cut or suspended dividends. We didn't see anything happen to Canadian banks. Gives you a sense for how stable they are, how their capital ratios are relatively high, giving them a good cushion against volatility in the economy. What has stood out on the financials done very well are some of our life cos. So Manulife, which is a Canadian but global life insurer with a very well robust wealth management, asset management business, done very well, and that's been a major holding in the portfolio. So we think those types of businesses will continue to do well over time, but the banks are really the ones that are going to play catch up here as rates start coming down.
Great. Well, Dean, I think that's a positive note on which to finish. So thanks very much for joining me. And if you are watching and you want to learn more about Middlefield Canadian Income, then just head over to the Kepler Trust Intelligence website, because we have a research note there on the trust. And actually, we have another piece of research coming out, which will include the trust soon as well. So definitely have a read of that if you're interested and want to learn more. Thanks for watching, and we'll see you next time.